Welcome back to the deep dive. Our mission today is, well, it's pretty foundational. We are going to set aside all the noise of the daily market swings, the quarterly earnings calls.
All that chatter.
All that chatter, exactly. And we're going to try to crack the code on what true corporate financial strength really looks like. We aren't looking at simple profits. We're looking at the engine, the efficiency engine that drives those profits. We are diving deep into what might be the paramount metric for assessing a company's fundamental genius, and that is return on invested capital, or ROIC.
That's right. And we're asking a really crucial question here. How efficiently do the biggest companies on the planet, I mean the undisputed titans of the S&P 500, how efficiently do they turn the billions, and I mean billions, in capital entrusted to them into real, sustainable profit?
Yeah.
So this whole deep dive, it's built on a stack of comprehensive sources, and we're focusing on ROIC from first principles. Then we're going to apply that analysis to 10 of the market's absolute heavyweights. We're talking Microsoft, Apple, NVIDIA, Amazon, Alphabet.
The usual suspects.
The usual suspects, exactly. Meta, Berkshire Hathaway, Broadcom, Tesla, and Walmart.
Our mission here is really to give you a shortcut. We want to help you understand which of these giants are not just making money, that's the easy part to see, but which ones are the absolute masters of capital allocation.
And that's the key. It's the difference between simple success and, well, structural, compounding financial brilliance.
It really is.
And, you know, the composition of this group is interesting. It's heavily weighted towards technology, or at least tech-enabled businesses. And that gives us a unique window.
How so?
Well, their collective ROIC profiles, they tell us a great deal about where economic value is truly being created in the modern market, and maybe more importantly, how entrenched their competitive advantages actually are.
Okay, let's unpack this then. There's a foundational analogy from the source material that I think just perfectly illustrates why ROIC is what they call the genius test.
Oh, I love this one.
Imagine, if you will, two rival hot pot chain owners. Let's call them Old Wang and Old Lai. Now, they both managed to earn the exact same $20 in net profit in a year.
Right. And on the surface, if you were, a novice analyst, just looking at that bottom line, that net profit, you'd probably assume they were equally successful.
Of course.
But they are worlds apart in terms of efficiency.
Exactly. So Old Wang, he's the genius entrepreneur in this story. He was super efficient. He only invested $100, just enough for the basic equipment, the ingredients, nothing fancy.
Right.
His $20 profit on that $100 investment gives him a massive 20% return on invested capital.
20%, that's a huge number.
It is. Now, Old Lai, on the other hand, he was obsessed with appearances. He invested $1,000, lavish decor, marble floors, the most expensive location, probably funded by a huge loan. He still only earned $20 in profit.
So his return is, what, just 2%?
A mere 2%. I mean, if you only looked at net income or maybe even earnings per share, these two businesses might look comparable, especially if their revenue was similar.
But in pure financial logic, Old Wang is the clear winner. He's the efficient capital allocator, generating these high returns on just minimal resources. Old Lai, despite that impressive facade, is actually destroying value relative to the capital he deployed.
So ROIC is that critical metric. It's the one that separates the true wealth creators, the efficient operators, from those who just achieve headline success through sheer capital brute force. It really asks the question, are you rich because you were smart, or are you just rich because you had a lot of money to start with?
That is the core concept we really need to internalize today. Now, before we apply this lens to the S&P 500 giants, we do have an important mandatory disclaimer. All the analysis and all the figures we're about to share today are based entirely on publicly available sources, and they're for educational purposes only. This content does not constitute investment advice. We strongly encourage you, the listener, to conduct your own due diligence before making any investment decisions.
Please do.
And for those of you who want to track the total market temperature using some of these deep value metrics, you're welcome to search for and download our iOS app, Buffett Indicator, right from the Apple App Store. And for more advanced content and deep dives just like this one, feel free to join our Deep Value Club membership.
All right, let's get into the mechanical details of this genius test. At its most fundamental level, ROIC measures the efficiency with which a company uses the funds entrusted to it. And that's from both debt and equity holders.
Right, from everyone.
From everyone. And how it uses those funds to generate profitable returns. It links the operational success, that's the numerator, directly to the total pool of resources deployed, which is the denominator.
And that ability, the ability of ROIC to bridge the operations of the company with its financing structure, that's what gives it its unique power. It is, I would argue, the most critical indicator for evaluating how effective management is at allocating capital. And critically, for gauging the strength and the durability of a company's competitive advantage. that elusive economic moat we're always talking about.
And this is precisely why it's so much better than the metrics we see dominating the financial headlines all the time. I mean, why should an informed investor look at ROIC rather than, say, net profit margin or return on equity, ROE?
Well, net profit margin is, it's a necessary metric, but it only relates profit to sales. It completely ignores the capital investment that was required to achieve those sales.
Right.
You could have a high-margin coffee shop that had to build a $5 million custom storefront. It might have a lower ROIC than a small, high-volume vendor who's just operating out of a leased kiosk.
Okay, that makes sense. And what about ROE?
As for ROE, while it's useful for equity holders, it has a fatal flaw. It can be artificially inflated by excessive leverage.
Meaning a company with a ton of debt might show a high ROE simply because the denominator, the equity part, is small, even if the overall business is actually really leveraged and inefficient.
Precisely. And ROIC avoids this distortion. It gives you a truly holistic view because it considers all capital providers, both debt and equity, and it focuses purely on the operational returns generated by that capital before any of that financial engineering or leverage gets applied.
Okay, let's start with the top half of that equation then, the numerator. NOPAT, net operating profit after tax. This needs to be the cleanest possible measure of earnings, right?
Absolutely. NOPAT is essentially the company's operating income if it were financed entirely by equity. The whole goal is to isolate the profitability that stems purely from the core business operations.
So you're stripping things away.
We strip away the influence of financing decisions. So things like interest income or expense, and also non-operating items like, say, a gain from an asset sale. This gives us a really stable and comparable measure of the company's ongoing core earning power.
So the standard starting point for this is operating income or EBIT earnings before interest and taxes. That makes sense since it's before the financing decision. But then we have to account for taxes.
Correct. The formula is NOPAT equals operating income, or EBIT, multiplied by 1 minus the effective tax rate. But the crucial nuance here, and this is where a lot of simplified calculations go astray, is the timing of that tax deduction.
Wait, hold on. Focusing on NOPAT means we're stripping out interest expense. But you're saying we adjust for taxes first. Walk us through why that specific order is so critical for getting an unbiased view of operations.
It's a cornerstone of valuation theory, really.
Yeah.
We treat taxes as a genuine, non-negotiable cash outflow that impacts all capital providers, both debt and equity. So we standardize this tax impact before we account for the tax shield benefits that arise from the interest expense on debt.
Ah, the tax shield.
Right. If a company uses debt, it gets to deduct that interest expense before it calculates its taxable income, which, lowers its tax bill.
So that tax savings, that tax shield benefit, that's a function of the company's capital structure, not its core operations.
Exactly. And since the entire purpose of ROIC is to measure pure operational efficiency, independent of the capital structure, we exclude that tax shield here. That benefit is instead implicitly factored into the denominator. Specifically when we calculate WACC, the cost of capital, where we use the after-tax cost of debt.
I see.
This clean division ensures the numerator, NOPAT, is a true reflection of the business's earning power. It's a critical adjustment, especially when a company's reported net income is really volatile because of, say, debt restructuring or some unusual non-operating gain.
That brings a lot of clarity to the profit side. So now for the denominator. Invested capital, or IC, this is the total capital base the company is actively putting to work.
Right. Invested capital is defined as the total sum of debt and equity capital raised by the company that is actively used to fund its net operating assets. It's the money that management is responsible for deploying effectively.
The sources for this deep dive primarily relied on the financing approach for calculating IC. Can you quickly recap what that is?
Sure. The financing approach is generally more accessible because the figures are pretty clearly separated on the balance sheet. It's just total debt, both short-term and long-term, plus total shareholders' equity. It's simple. What resources did the company raise?
But the more rigorous way, especially for these huge tech firms we're looking at, often involves the operating approach, looking at the asset side instead. Things like operating working capital plus net property, plant and equipment plus intangibles. Why is that second approach often preferred by more advanced analysts?
It boils down to one word, really.
Yeah.
Excess cash. This is the critical adjustment that differentiates a superficial analysis from a deep one. Companies like Apple or Alphabet or Microsoft, they often hold these massive multi-billion-dollar reserves of cash and marketable securities that are not actively deployed in their core operations. They're essentially just liquid investments sitting on the sidelines.
So if we use that unadjusted financing approach, debt plus equity. For a company like Apple, wouldn't we include all that cash because it was ultimately financed by the equity holders?
You would. You absolutely would. And by including capital that is not actively employed in generating those operating profits, you artificially inflate the invested capital denominator.
Which makes the company look less efficient than it truly is.
Exactly. The operating approach aims to exclude this non-operating cash by focusing only on the assets that are directly necessary for the operations.
So to get the cleanest ROIC for a tech giant, we should, ideally, subtract that excess cash from the total invested capital figure we get from the financing approach.
Absolutely. The principle has to be followed, even if the exact calculation can be complex. You have to measure the return only on the capital that is active. Now, if the cash is genuinely required for daily operations, like, say, Walmart needing cash for a big seasonal inventory purchase, it stays in. If it's purely an investment portfolio, it should be subtracted.
And finally, the modern elephant in the room, intangible assets. Goodwill, brands, intellectual property, these must be included, right?
They absolutely must. Goodwill, which comes from acquisitions, and capitalized intangible assets like patents or proprietary software, were all financed by the debt and equity holders.
So they're part of the investment.
They're part of the total investment. Excluding them would fundamentally understate the true capital base that's driving revenues, especially in the asset-light tech sector we're looking at. If you exclude goodwill from the denominator after a major acquisition, you just artificially inflate the ROIC, creating a completely false sense of efficiency. We have to ensure the IC calculation comprehensively captures the entire capital base that's at work.
Okay, so we've calculated our NOCAT and our IC, and we have our ROIC percentage. Let's say we land on 15%. How do we know if that's a stellar result or, a failing grade? This brings us to the ultimate comparison, ROIC versus the weighted average cost of capital, or WACC.
WACC, right. So WACC is the minimum blended average rate of return a company has to achieve to satisfy all of its financial stakeholders, both the creditors and the shareholders.
Okay.
Think of it as the company's internal hurdle rate. It reflects the opportunity cost of capital based on the risk profile of the business.
So if I put my money into a company, WACC represents the rate of return I could generally expect to get in the market for an investment of comparable risk. If the company fails to earn that, they essentially wasted my capital.
That's exactly right. The concept itself is pretty straightforward, but the calculation of WACC is far more involved than ROIC. It involves weighting the after-tax cost of debt and the cost of equity.
Let's break down the components for our audience here. How is the cost of equity typically determined?
We usually rely on the capital asset pricing model, or CAPM. This states that the cost of equity is the risk-free rate. That's often the yield on long-term government bonds, plus a risk premium. And that premium is calculated by taking the market risk premium and multiplying it by the company's beta.
Beta being the measure of the company's stock volatility relative to the overall market. So a high beta means higher risk, which demands a higher return and therefore a higher WACC.
Correct. And while this model is standard, this is where that subjectivity critique comes in that a listener brought up. Estimating WACC is not a perfect science.
Right.
Analysts are frequently arguing over the correct equity risk premium to use, or the appropriate risk-free rate, and whether a historical beta truly reflects future systematic risk. The resulting WACC figure is often a range, not some single immutable number.
That makes a lot of sense. I mean, even a small change in that estimated WACC can fundamentally alter whether we perceive a company to be creating value or, well, destroying it.
Absolutely. But regardless of the precision, it's the comparison that matters. And this leads us to the three fundamental scenarios.
Okay, scenario one, ROIC is greater than WACC.
The ideal scenario. This is what you want to see. The company is generating returns that exceed the cost of the capital it employs. That difference, we call it the spread, that's the economic profit or economic value added. This surplus return is the true engine of shareholder wealth creation.
Scenario two, ROIC equals WACC.
Here, the company is just meeting the minimum expectations of its capital providers. It's sustaining its value, but it's generating zero net economic profit. It's stable, but not generating any surplus wealth.
And the danger zone. ROIC is less than WACC.
This is a huge warning sign. The company's returns are insufficient to cover its cost of capital, and it is actively destroying value. Management is deploying capital in ventures that yield less than the market demands for that level of risk. So that spread, that ROIC minus WACC, that's the measure of the economic rent earned, which is intrinsically linked to the company's competitive advantages or its moats.
So when we talk about a good ROIC, we really have to always start by referencing WACC. But setting WACC aside for just a moment, what general guidelines exist out there?
Well, analysts generally agree that a company must consistently exceed its WACC by a meaningful margin. If your ROIC is only just above WACC by, say, less than 2 percentage points, the margin for error is just too thin.
Okay.
For general benchmarks in developed markets, 10 to 15% is often considered consistently good. It shows resilience, a basic moat, returns of 20% or higher. That's truly exceptional. It's indicative of rare market dominance or highly defensible asset-light models.
But we can't look at that 20% in isolation, can we? You can't compare a utility company's 8% ROIC to a software firm's 30%. It's all about context.
Context. It's non-negotiable. Capital-intensive sectors like utilities, railroads, heavy manufacturing, they have a huge physical asset base that sits in the denominator. It just naturally compresses ROIC. Their WACCs are also typically lower due to stable cash flows and high debt capacity. But asset-light sectors, software, specialized pharma, consulting, they require minimal physical capital, and therefore they achieve structurally higher ROICs. A 12% ROIC for a steel manufacturer might be world-class, while 12% for a social media platform would be alarming.
And what about scrutinizing the exceptionally high returns we're about to discuss? I mean, when NVIDIA hits 80%, is that a guaranteed good sign?
It's a guaranteed sign of current strength, for sure, but you must immediately question its sustainability. Extremely high ROICs, they just scream of superior execution and massive pricing power, but they also act like a beacon.
Attracting competition.
Exactly. If those returns are not fiercely protected by durable, formidable competitive advantages, regulatory barriers, IP, network effects, they will attract overwhelming capital and aggressive competition. And that will eventually erode those returns back toward the industry average WACC. The persistence of that high figure matters far more than a momentary spike.
Let's pivot back to the idea of growth, because this is a critical distinction. The difference between value-enhancing growth and value-destroying growth.
This is the concept of true growth versus the false growth company, or Zupang, which the source material translates to puffy or bloated growth, growth without substance. And this is the most essential insight ROIC provides.
The danger being that a company can post these huge year-over-year revenue growth numbers and yet be fundamentally losing money for its investors.
Precisely. Let's say a company's ROIC is, say, 5%, but its WACC, its actual cost of funding, is 10%. Every single dollar the company raises to expand, to build a new distribution center, to launch a new product line,
It's losing money.
it's only generating 5 cents in return on a 10-cent cost. That expansion, even though it appears as revenue growth on the income statement, is actively accelerating value destruction.
That is a staggering disconnect. The company might be the darling of Silicon Valley based on projected growth, but structurally, it's a capital allocation disaster.
It is the definition of Zupang. The company looks impressive on the surface, but it is structurally inefficient, and it's bleeding economic value. For growth to be value-enhancing, ROIC must be significantly higher than WACC. If it's not, the company's best strategy would probably be to stop expanding and just return capital to shareholders. This is why ROIC is the quality filter. PE, or valuation metrics, they tell us if a stock is cheap or expensive based on market expectations. ROIC tells us if the underlying business is truly strong and capable of efficient compounding wealth generation.
All right, now we move to the application. We're moving from theory to the reality of the market's largest players. We are applying the ROIC formula NOPAT divided by invested capital to our cohort of 10 S&P 500 titans using their latest full-year financial data.
And this group, collectively, they hold staggering market value. And their diverse ROIC profiles, ranging from over 80% down to just over 6%, they reflect these deep structural differences in business models, from asset-light cloud services to capital-heavy manufacturing.
Let's start at the absolute peak, the ultra-high performers, where the returns are so high they almost redefine what's possible in finance.
The leader, and it's by a massive margin, is NVIDIA.
NVIDIA clocked in with an extraordinary ROIC of 80.48% for its latest fiscal year. That is a figure that requires immediate scrutiny for sustainability.
It's indicative of a near-monopoly position at a point of massive technological inflection. This ROIC results from explosive profitability driven by the current overwhelming demand for its high-end AI accelerators, the H100s, the related chips, and the data center market.
Right.
They have immense pricing power due to their specialized CAD software ecosystem, which acts as a really powerful switching cost mode. And critically, their invested capital denominator is relatively contained because of their business model. They are a fabless company.
Meaning they design the highly complex chips, but they outsource the actual, really capital-intensive manufacturing, the fabrication plants, to partners like TSMC.
Exactly. So they get the high-margin revenue from the design and the IP, but they avoid having to raise and deploy tens of billions in capital into foundries. That keeps the IC denominator dramatically smaller than if they were an integrated device manufacturer. This combination, Staggering pricing power and a capital-light model. That's what creates an 80% return.
Right behind them and maintaining dominance for decades is Apple at 57.17%.
Apple's consistently high number is just a masterpiece of financial engineering and qualitative moats. They command premium pricing because of the strength of their brand and their ecosystem, and their highly profitable capital-light services segment continues to grow, leveraging that massive installed hardware base. But there is a crucial quantifiable factor here too.
The listener asked for a deep dive on how capital structure affects this figure. Is this where the massive history of share repurchases comes into play?
It is absolutely critical. Apple has executed arguably the largest, most consistent share repurchase program in history. By continually buying back and retiring stock, they significantly reduce the total shareholders' equity component of the invested capital denominator.
So for a given level of NOPAT,
For a given level of robust NOPAT, reducing the denominator pushes the resulting ROIC figure higher. This ROIC reflects not just operational efficiency, but a management team that's hyper-focused on compounding returns through disciplined capital return. That's the challenge of consolidated analysis. Reality Labs, Meta's metaverse segment, currently operates at a huge loss. These investments significantly increase the total invested capital, the denominator, and they suppress the consolidated NOPAT, the numerator. The fact that Meta can maintain an ROIC near 30% despite that massive loss-making drag demonstrates just how explosively profitable the core advertising business really is. We are looking at a high ROIC engine carrying a low ROIC startup within its structure.
And speaking of structural stability, Microsoft is at a robust 28.15%, with Alphabet, Google, right behind at 27.76%.
These figures are the hallmark of entrenched, multifaceted competitive advantages. Microsoft leverages its dominance through high switching costs in enterprise software like Office 365 and the scale advantages of Azure, its cloud segment. Alphabet's returns are underpinned by its near monopoly in search advertising, which is a classic network effect. These are businesses that generate massive NOCAT relative to their investment in physical assets, allowing them to consistently compound capital well above their WACC.
Now let's turn to the hybrid and stable businesses, where the figures moderate a bit, reflecting a blend of asset-light and asset-heavy operations. Amazon at 17.25%.
This is where we need to apply that critical lens.
Yeah.
17.25% is a healthy, value-creating ROIC, no question. However, it's significantly lower than Microsoft or Meta. Why? Because this figure is a blend of two vastly different capital structures.
I have to challenge this blended figure. If Amazon Web Services, AWS, is generating returns that look more like Microsoft's, but the core retail and logistics business is consuming massive capital distribution centers, trucks, inventory, is that 17% figure hiding a colossal capital allocation error in the retail segment?
That is the precise question an advanced analyst must ask. Our sources indicate that AWS operates with a much higher ROIC, likely in the 30% plus range, driven by its scale and proprietary tech.
Right.
The retail and logistics segment, however, is intensely capital intensive. Building a new automated fulfillment center costs billions and immediately hits that invested capital denominator. While those automation investments are designed to boost future NOPAT, the immediate effect is a massive IC denominator increase, which pulls the consolidated ROIC down to 17%. We're seeing the tension between a high-growth, high-margin, asset-light tech segment and a huge, capital-heavy logistics segment. The combined figure shows value creation, but drilling down is essential.
And representing the traditional but highly efficient retail model, we have Walmart at 10.79%.
This is a respectable and, I'd say, compelling ROIC for its industry. Walmart is in a classic capital-intensive sector. They need physical stores, massive inventory, complex global logistics. Their strength lies not in achieving high margins, but in achieving unparalleled asset turnover.
Getting goods in and out quickly.
Exactly. Generating high sales velocity relative to the capital tied up in inventory in stores. That 10.8% is a testament to their scale and relentless efficiency focus in the supply chain, allowing them to remain a strong value creator despite the structural capital requirements of retail.
Finally, let's examine the bottom three, the capital-intensive and conglomerate cases, where context is absolutely paramount for accurate interpretation. We have Berkshire Hathaway, Tesla, and Broadcom, all falling below 10%.
And we must apply maximum caution here, starting with Berkshire Hathaway at a modest 7.63%. This cannot be compared directly to a pure-play tech company.
Why does Berkshire's structure break the direct ROIC comparison rule?
Because it's a conglomerate whose invested capital includes vast equity investment portfolios, huge cash holdings, and most importantly, the insurance float. The insurance float is capital generated by premiums they receive but haven't yet paid out in claims. This float is used to invest, but it has to be held for regulatory reasons, and it's considered a source of non-interest-bearing capital within that IC base.
So their IC denominator is huge because of these regulatory and investment components, not just operating assets like the BNSF Railway.
Exactly. That 7.6% is a blended rate across railroads, utilities, insurance, manufacturing, and public equity holdings. Berkshire's primary value creation metric is traditionally the long-term growth in book value per share and intrinsic value. That captures the cumulative effect of astute capital allocation over decades, rather than a single period's consolidated operational efficiency against a generic WACC.
Okay, next, the most debated figure on the list, I'm sure. Tesla with a relatively low ROIC of 6.95%. For a high-growth company, that sounds dangerously close to, or perhaps even below, its WACC.
This is the definitive example of a current ROIC being depressed by a heavy investment phase. The automotive industry is inherently capital-intensive. Tesla is engaged in massive global capacity expansion, new gigafactories, battery production, vertically integrated manufacturing, all of which inflate the invested capital denominator dramatically.
And how does their aggressive R&D strategy impact the numerator, NOPAT?
It acts as a major drag. Tesla continually expenses massive R&D costs for new models, battery tech, full self-driving development. As they are incurred, this aggressive expensing immediately suppresses current NOPAT. So you have a double whammy, a huge denominator from CapEx and a suppressed numerator from R&D expensing. The low figure isn't necessarily a sign of failure, but a snapshot of a company betting heavily on future returns.
So investors are essentially accepting a low return today, hoping that the competitive advantages generated by those investments, better battery, higher automation, will lead to a massive, sustained ROIC spike years down the road.
That is the entire investment thesis. If that 6.95% is below their WACC, they are currently destroying value, but they are arguing that the trend of ROIC, driven by technology and scale, will quickly exceed WACC and compound massively. The sustainability of their competitive advantage is the absolute key.
And finally, the lowest figure in our list, Broadcom at 6.19%.
Broadcom's low ROIC is a textbook illustration of the financial drag caused by aggressive, debt-financed mergers and acquisitions. When Broadcom executes these large deals, they take on significant debt and they record substantial amounts of goodwill and other intangible assets, like customer relationships, on the balance sheet. This dramatically increases the invested capital denominator.
So if the acquired company's NOPAT doesn't immediately catch up to the increased IC, the ratio suffers. It's like buying an expensive toolbox before you've used the tools to build anything.
Exactly. You could view that goodwill and IC increase as a kind of prepaid synergy bill. The value of the acquisition is in the future synergies and cost savings, which will boost NOPAT over time. Until those synergies are fully realized, the calculated ROIC is depressed. Furthermore, the source material noted a specific factor in their latest fiscal year, an unusually high effective tax rate near 38%, which aggressively depressed the NOPAT, contributing heavily to this low 6.19% figure. An analyst has to adjust for such non-recurring or unusual tax items to get a true operational picture.
Summarizing this whole cohort, then, it seems the highest returns are reserved for companies that possess both high-margin products and capital-light models. NVIDIA, Apple, Meta. But the minute you introduce manufacturing or heavy logistics, like with Amazon, Tesla, Walmart, the ROIC naturally moderates. And that places immense pressure on management to achieve superior asset turnover and operational efficiency.
It underscores a crucial reality. In the modern economy, the durable economic mode is often found in intangible assets, network effects, and proprietary software, not necessarily in physical assets. And those qualitative advantages are what enable the highest ROICs.
So for a management team that wants to move their company from, say, Walmart's respectable 10% to Microsoft's 28%, what are the actionable strategies for improving ROIC?
Well, the path is mathematically clear. You either increase the numerator, NOPAT, or you decrease the denominator, invested capital. Or preferably, you execute both simultaneously. This is often summarized through the DuPont analysis framework for ROIC.
Let's detail the NOPAT strategies first. How do you go about boosting operational profit?
The first step is margin expansion. This can be achieved through better strategic pricing, moving the product mix toward higher margin offerings, like we saw with Apple's emphasis on services over low-end hardware.
Okay.
It also includes optimizing the cost structure, reducing COGS through better sourcing, streamlining supply chains, or cutting operating expenses through digital transformation and outsourcing. Essentially, you want to achieve operational leverage, where every new dollar of revenue costs less to generate.
And what about the other side of the fraction? Decreasing invested capital or just using it more efficiently?
This is where we focus on asset turnover and capital discipline. Companies have to generate more revenue from the existing asset base they have. For a capital-intensive business like Walmart, this means accelerating inventory velocity, reducing the time that capital is tied up in inventory. Efficient working capital management is also crucial. Extending payable terms while accelerating collection of receivables minimizes the amount of cash required to run the day-to-day business.
And strategically, how does management make decisions about future investment?
By instilling relentless capital discipline. Every single dollar proposed for a new project, for CapEx, for an acquisition, it must pass a rigorous internal hurdle rate that significantly exceeds the company's WACC.
No exceptions.
No exceptions. If a project is only expected to return 8%, but the WACC is 10%, that project is a net value destroyer and it has to be avoided. Furthermore, management must be willing to divest non-core or underperforming assets businesses currently generating an ROIC below WACC. Selling those assets frees up capital that can then be returned to shareholders or deployed into higher return internal opportunities.
So at its core, focusing on ROIC truly requires a culture shift within a corporation.
Absolutely. It changes management's incentive structure. Instead of just chasing simple top-line revenue growth, the focus shifts to quality growth that is capital efficient. It aligns managerial actions directly with the long-term goal of compounding shareholder value by rigorously justifying every single capital deployment decision.
Now, we absolutely have to address the limitations. If ROIC is so powerful, what are the common pitfalls and nuances that can lead to a flawed analysis?
The first, and maybe the most obvious, is that ROIC is inherently a historical measure. It tells you what happened in the last fiscal year, but it is not a forward-looking indicator, especially in fast-changing industries where competitive dynamics can shift really rapidly.
And the major accounting policy headache. I mean, when you're comparing a U.S. company that uses LIFO inventory accounting to a European firm that uses FIFO, the numbers can be skewed without careful adjustments.
Exactly. Differences in depreciation schedules, inventory valuation, capitalization policies, they can all alter both NOPAT and IC, making intercompany comparison very difficult. For instance, differing rules on capitalizing software development costs can change the appearance of efficiency. The lack of granularity is also a major limitation. As we saw with Amazon and Berkshire, a consolidated ROIC can mask fundamental performance disparities between segments.
Let's deep dive into the most critical limitation for these tech titans we've been talking about: the treatment of intangible assets, particularly internally generated R&D.
This is a major structural challenge for modern analysis.
Yeah.
U.S. GAAP typically requires that R&D expenses be expensed immediately on the income statement. So think about a company like Tesla spending billions on developing FSD software. That expenditure immediately reduces NOPAT.
But if that R&D creates a valuable proprietary asset like the FSD software or a breakthrough battery patent that was financed by equity, shouldn't it be captured in invested capital?
It absolutely should, but under current accounting rules, it is not. Since R&D is expense, it has a zero book value on the balance sheet. Therefore, the invested capital denominator is understated, while the NOPAT numerator is aggressively suppressed. This creates volatility, and it can potentially artificially inflate the ROIC for mature, asset-light firms, while simultaneously depressing the current ROIC for high-growth firms like Tesla that are pouring billions into R&D for future gains.
That's a fascinating accounting paradox. The rule that's intended for conservatism actually creates a potentially misleading picture of capital efficiency during periods of heavy investment.
It forces the analyst to use judgment. For high R&D firms, advanced analysis often involves capitalizing R&D, adding back the R&D expenditure to NOPAT, and adding a capitalized R&D asset to the invested capital denominator to get a more economically accurate picture of true operational efficiency. This adjustment often substantially lowers the ROIC of mature tech firms, while potentially stabilizing the ROIC of growth firms.
And finally, we saw the Tesla example, the risk of focusing too much on short-term ROIC.
Right. If management becomes obsessed with maximizing ROIC on a quarterly or yearly basis, they risk underinvesting in the very R&D, market development, or foundational infrastructure that's necessary for securing future competitive advantages. They might avoid a project with a 12% expected return if their current ROIC is 30%, even if that 12% project is crucial for maintaining market share a decade from now. Management has to balance current efficiency with long-term strategic positioning.
So what does this all mean for our listener? How do we place ROIC in the broader context of sound financial analysis?
ROIC is the most vital instrument in the toolkit, but it is not a complete picture. It has to be triangulated. You must look at growth metrics, revenue, and free cash flow growth to understand the trajectory. You have to analyze free cash flow to determine the actual cash available to investors after necessary CapEx. You need to look at other profitability ratios like RE and ROA to fully gauge the impact of leverage. And critically, you need the qualitative factors: management quality, long-term vision, and the durability of those economic moats. ROIC tells you if the business is strong today, but you need the rest of the picture to assess its compounding potential tomorrow.
To sum up the enduring relevance of ROIC, it really can't be overstated. It is a core measure of investment quality and efficiency. It signals which companies are not only growing, but growing profitably and efficiently, and thereby enabling effective long-term capital compounding.
And our deep dive into the S&P 500's largest companies showed a staggering spectrum of performance, from NVIDIA's 80% all the way down to Broadcom's 6%. This range is a direct reflection of structural differences in business models, competitive advantages, and capital intensity. It really confirms that context is everything when assessing these figures.
And that efficiency premium is precisely what you are paying for when you invest in a firm like Apple or Microsoft. You are paying for management's proven, disciplined track record of being excellent capital allocators who consistently generate returns far, far above the cost of capital.
Which brings us to our final provocative thought for you to mull over. We saw how massive strategic investments in R&D and manufacturing capacity can temporarily depress the current ROIC of companies like Tesla, pushing it significantly below industry benchmarks. The question for you, the investor, is this. How long is an investor truly justified in accepting a low ROIC, perhaps one that is less than WACC for a high-growth company, betting entirely on future potential?
At what point does that future potential cross the line, becoming what the sources called value destruction growth, where continued expansion only accelerates the economic losses?
The answer lies in the trend. Is the ROIC figure improving year over year? And in the durability of the competitive advantages those current investments are designed to create. Thank you for joining us for this deep dive into capital efficiency.
We'll catch you on the next one.